Welcome back to the channel. As always, if you copy trading, you're an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to look today at a well-known company called GES Incorporated, ticker GES. And of course, you know this company, they are a retailer of fashion. So typically selling globally, where Europe is one of their main revenue regions. And they specialize primarily in jeans, pants, skirts, and they are at the moment in a period of transition for multiple reasons. One, they are transitioning from a single product type to a platform with different brands and products. So that is through the introduction of higher end segment as well as the acquisition of a brand earlier this year called Rag & Bone, which we will discuss a bit in later in the video. So, as you can see, the stock has been ranging for quite some time. The peak that we saw here back in March was prompted by this acquisition, which of course was very well received by the market. However, we see that the stock has been in a downward trend since. And if you look at the multiple, let's remove this here, and this as well, and this. You can see that after the uh, bear market period in 2022, the valuation recovered to uh, these levels around here, right? Around 7 times, and maintained that over 2023 and 2024, but it's now coming back to those levels. And to me, that signals that the market is not feeling so good about this company anymore. It's revisiting the more bearish multiples that we saw back then. But of course, there are not only issues with the valuation, but also with the actual operation itself. And that's what's driving lower the stock price, which if you see is quite significant, right? It went from almost 30 in March to 17. So the stock is almost down 50% in the space of a few months. As a matter of fact, it's down, as you can see here, more than 20% in 3 months. So why is that? So they have experienced a number of issues with their operation that led them to show declining operating margins. So the last report in August was not pretty good. Operating margins declined to 5.2 versus year prior at 9.8. So that is a big drop. Additionally, the guidance was downgraded due to the following reasons. They're seeing higher freight rates, which have been exacerbated by the Red Sea crisis, and I have my own opinions about that. I don't think that's a conflict that's going to alleviate anytime soon. Maybe not necessarily get worse, but I don't think it's going to come to an end in the near term. But they also, as a brand, have been experiencing some issues. They have seen softer traffic trends versus their expectations and lower conversion rates. In other words, their ability to convert sales versus all the efforts that go into it, promotions, marketing, and so on. At the same time, these expectations were a stark contrast with compared to what the company saw at the beginning of the year, where they were actually upgrading their estimates for the year. So that's pretty bad for the sentiment of the stock, right? When you have upgraded expectations and then you have to downgrade them, it reflects poorly on management's ability to forecast about how to run the business. But if we look at the retail traffic and conversions, Management actually expects for this negative trend to continue over the next couple of quarters. And we can see here in this drop since 17th of October that that's likely to continue, but potentially maybe even exacerbated by new tensions in the Middle East that we have seen. So overall, not good for the company. They also are seeing weakness in the American sector, which is obviously the most interesting from a revenue perspective. And whilst they're doing okay in Europe, you could argue that that's an area that suffers from stagnating growth. So you see limited upside for this company. Asia's not doing good either, with slowing revenues too. So all those things are not good. You have significant increase as well in SG&A, up 23% year on year. That's because the company is going through a transformation in their operation. They're trying to increase their user experience for online sales. They're increasing by 100% their marketing costs year on year, and they're also facing increased costs in store occupancy. So all those things, as well as the initiatives that they're putting in place to take the company to the next level, means that they have increasing debt that is putting pressure on margins. So when you look at the balance sheet, this is causing a number of concerns for investors. We saw in the last quarter rising inventory levels, up 9% year on year. Now, that is not a crazy amount to be too worried about. That is also partly driven by the acquisition of Rag & Bone, which is going to become the high-end offering within their platform. So that's partly the reason why they have these increased inventories. However, if those issues that we have seen before, the slow conversion, lower traffic, if those issues persist, the risk of markdown could be exacerbated. And so that could become a challenge down the line. But overall, the balance sheet as a whole sees increased debt levels, working capital pressure, lower free cash flow guidance to 100 million down from 160. And as we mentioned before, the company is trying to grow and evolve, and that requires higher capital needs to fund those growth initiatives. At the same time, it is not very clear when and how those new initiatives are going to add a return back to the company. And that poses, in my view, a greater issue that is currently the elephant in the room for this company, the credibility of management. They have a very seasoned team, which I think we can find here. Many of these guys, as you can see, 68 years old, some of them 61, fairly senior board of directors, right? And if you look at them, none of them have been around for long. So most of them joined like a year ago, sometimes even less. But it's not only the people on board that I think could perhaps not move as fast as the company needs in order to realize those ambitions. It's the fact that their CFO recently departed to join Puma, the German sports retailer. Initially, the reasons were that he was leaving to be closer to family, which is a euphemism, of course. But now that we know that he has moved to a different company, it signals that he has probably secured a better job elsewhere, and things do not look that interesting. So at the moment, the company is looking for a replacement, But it's also looking for new positions to fill with new roles that have been created as Chief Commercial Officer and Chief Digital Officer. Now, I think that could be very good down the line. However, let's not forget that these guys here are still going to continue at the helm. They're still arguably learning the job. And it may be, and this is, I think, the the risk, right? That is too much, too fast for management to keep up with everything. We're looking at a transformation of the business model. We're looking at a transformation of their offering, and this is starting to show, as I mentioned earlier, on sloppy performance with multiple guidance revisions up and down throughout the year, declining performance metrics, and ambitious plans to turn the company around and make it better amidst all these challenges that they're having. To me, it just seems that they're not addressing the most urgent problems that they have in front of them. They're focusing on a complex transformation, right, in terms of moving from a regional to global structure, whilst creating new global positions, centralizing functions, and building new capabilities. But if we go back to the beginning and look at what they're trying to do, they're trying to integrate Rag and Bone, which is the first acquisition for the company ever. So this is apparently not a very M&A savvy team. They're also launching a new brand, GES Jeans, and they're also expanding geographically and transitioning to a distribution center model. So I just feel that there's a lot of risks here, a lot of things changing, and that could lead to many surprises down the line. So we could see the stock dropping significantly on issues that may have not been communicated even before the next earnings report on the 27th of November, so in about a month time. Onto the structure. I mentioned that earnings are on the 27th, and we can see here that the stock is trading at about 17.5. So I would probably be looking at selling the November 16th puts for 25 cents and buying the December 16th at 85 on a 2-for-1 ratio. If we do a quick back of the envelope calculation here, we can see that if we reach that 16 price target, we get uh, about a 40% payoff, but of course can be a lot more after that expiry. I'm potentially targeting somewhere around 14, which of course could be uh, feasible if these risks manifest. One more thing, this is one that I'm gonna keep on my watch list for now because the timing I don't think is quite right just yet. This would have been pretty good to enter a few days ago, but at the moment I just feel we are in a downward channel, and it is likely that if I decide to enter this one, I would wait for a pullback to go back to the top of this channel, probably around 18 or 19, but we have a month ahead to make the decision. Hope you enjoyed the video. See you soon.